Eurozone inflation just got confirmed at 2.2% for September 2025. That's basically a soft landing for prices, close to the European Central Bank's 2% target, without tipping into stagnation. Here's what that actually means, fast. First, price stability. Headline inflation at 2.2%, up a touch from 2.0% in August. Core inflation, so excluding energy and food, at 2.4%. Translation: the worst of the inflation spike is behind us, but demand hasn't died. That's a healthy balance for everyday consumers and for businesses setting prices. Second, the ECB. At 2.2%, there's no rush to cut interest rates. The bank can hold steady, watch the data, and avoid whiplash for borrowers and savers. For the euro, that stability is supportive. When rates stay relatively higher versus peers, the currency looks more attractive, especially to bond investors hunting for reliable yield. Third, stocks. Moderate inflation is usually the Goldilocks zone. Not too hot, so no aggressive tightening. Not too cold, so no demand scare. That backdrop tends to favor banks. Energy. Industrials that like predictable input costs and steady consumer demand. If we'd slipped under 2%, recession chatter would get louder. Over 3%, markets would price in sharper policy moves. At 2.2%, sentiment prefers the middle lane. Fourth, growth. Europe's not booming, but it's not breaking. Energy prices have calmed. Supply chains are smoother. Cost pressure is easing. Some countries still have weak factory output. But the region is dodging recession thanks to cautious consumer spending and gradual export recovery. Global angle. A stable Eurozone helps everyone tied to it. Think China, Turkey, Pakistan, and neighbors selling into the EU. Predictable prices keep European demand more reliable, which supports trade flows and, by extension, global confidence. Investor read. 2.2% screams normalizing. That's catnip for long-only funds. And global allocators who want lower-risk developed markets. If this path holds, headline near 2%, core easing, expect a slow drip of foreign capital back into European bonds and quality equities. What to watch next? Core inflation trend over the next two prints. Wage growth versus productivity, huge for service prices. And the ECB's language, data dependent, is the key phrase. Any surprise spike in energy could delay cuts. Any downside miss accelerates them. Bottom line, 2.2% isn't fireworks. It's better, it's credibility. An economy settling down, a currency supported by policy patience, and markets that can plan again. For businesses and investors, that's the green light to look at Europe with fresh, measured optimism. Thanks for watching. Stay informed, stay calm, and I'll see you in the next one.